Hey everyone, welcome back. If you're the kind of focused learner who loves digging into the real stories hiding behind corporate data, well, you're in exactly the right place. I'm super excited to have you here for another explainer. Let's just jump right in, because today we're looking at a pretty fascinating moment in the telecom world. We're going to unpack Charter Communications Q2 2026 earnings. Now, you probably know them best through their consumer brand Spectrum. What we've got here is honestly a classic story. It's a massive legacy giant trying to navigate a huge business transition in real time, and their earnings data literally lays out exactly how they plan to pull it off. Here's our quick roadmap for today. Number 1, massive scale and assets. Number 2, Q2 2026 financial results. 3, the mobile growth engine. 4, investing in the network. And finally, 5, capital strategy and debt. Now, before we get to the good stuff, just a quick housekeeping note. Today's explainer does rely on materials with forward-looking statements. You know the drill, right? Management's expectations are subject to risks and uncertainties, actual results could differ, all that standard disclaimer stuff. So just keep that in mind as we talk about their projections. All right, Section 1, massive scale and assets. Okay, so to really wrap our heads around the strategic pivot Spectrum is pulling off right now, we first have to grasp their sheer size. 31.5 million. That is the total number of customer relationships Charter has as of the second quarter of 2026. Guys, this isn't some nimble little startup trying to find its footing. This is a foundational piece of American infrastructure. When a company with over 30 million customers makes a move, the ripple effects hit the entire economy. It puts absolutely immense stakes on every single decision their management team makes. And naturally, those 31.5 million customers translate into some pretty breathtaking financials. Over the 12 months leading up to Q2 2026, they raked in roughly $54 billion in revenue. Just let that sink in for a second. $54 billion. That revenue cements Charter's status as an absolute financial juggernaut in the connectivity space. They've got this massive recurring revenue base, and that gives them the firepower they need to fund some seriously huge new initiatives. But how do they actually reach all those people to get that $54 billion? Well, it's built on a very real, very physical foundation. Charter's network has over 1.1 million network miles, passing right around 59 million homes and businesses across 41 different states. Plus, they've got about 45 million national wireless access points and over 300,000 fiber-lit buildings. It's like a giant physical moat that would be incredibly difficult for any competitor to just build from scratch. Moving on to Section 2, Q2 2026 financial results. Now, despite that incredible scale we just talked about, the quarterly financials show us that the landscape is definitely shifting. We're actually seeing a slight top-line contraction here. In Q2 of 2026, total revenue came in at $13.5 billion, which is a 1.7% decrease compared to the same time last year. And similarly, their adjusted EBITDA, which is a key measure of operating profitability, dropped 4.3% down to $5.4 billion. So looking at this impartially, the business is obviously still generating mountains of cash, but the overall growth engine for their traditional metrics, it's sputtered just a little bit this quarter. Let's break that revenue down just a little bit further to see what's going on. The core residential side of the business definitely experienced a slip, dropping 1.8% year over year. But it wasn't down across the board. Their commercial revenue, the side-serving businesses, actually saw a slight bump, growing by 1.5% to hit $1.9 billion. So that contraction we saw is heavily centered right on the consumer side of the house. All right, Section 3, the mobile growth engine. This is where the story gets super compelling. We are looking at two totally opposing forces operating inside Charter right now. On one side, you have the legacy services, traditional cable packages and standard home internet. Those are facing some real headwinds and seeing a declining base. But on the flip side, you have this surging, wildly fast-growing mobile segment. Spectrum is rapidly turning into a major player in the wireless space, and it's acting as this huge counterbalance to the drops in their older offerings. When you look at the raw numbers, the transition is pretty stark. In Q2 2026, Charter's traditional internet business lost 127,000 customers. Their video segment, the traditional cable TV side, lost 184,000 customers. But hold on, because their mobile business added a massive 406,000 lines in a single quarter. That brings their total mobile lines to 12.5 million, which is a 16% year-over-year growth rate. So the big takeaway here is this. Spectrum is bleeding legacy wireline and video customers, for sure, but they are aggressively replacing them by selling mobile lines to the people who are sticking around. Next up, Section 4, investing in the network. So to keep that shiny new mobile growth engine humming, you absolutely need state-of-the-art infrastructure. And Spectrum is deploying heavy capital into their physical footprint to the tune of $2.9 billion in the second quarter alone. A huge chunk of this, about $1.7 billion, is going straight to core network maintenance and upgrades. But they're also pouring $500 million into network evolution and $700 million into line extensions to reach new, mostly rural, areas. Basically, they're aggressively building out to support all that new mobile traffic, especially since 87% of Spectrum Mobile customer data is actually offloaded right back onto Charter's own network. Now, you might be wondering, can they keep spending like that forever? Well, they don't plan to. Understanding their multi-year CapEx outlook is totally vital for getting their strategy. For 2026, they expect capital spending to peak, holding steady at around $11.4 billion for the year. But once they get over this network evolution hump, so to speak, the spending is projected to drop way down. They forecast it'll fall to about $9.5 billion and then eventually settle into the $7.5 to $8 billion range in the following years. The play here is to spend heavily right now to future-proof the network so they can reap the cash flow rewards later when those capital requirements finally drop. And finally, Section 5. Capital, strategy, and debt. Obviously, all of this massive spending requires a pretty sophisticated financial structure. So how on earth are they paying for it all? Well, the first piece of the puzzle is leverage. As of Q2 2026, Charter's total debt sits at a staggering $93.8 billion. Yeah, you heard that right. It's vital to recognize the sheer scale of leverage they're using to operate. Their leverage ratio is hovering around 4.18 to 4.21 times their adjusted EBITDA. Now, in the telecom industry, high debt loads are pretty common because those subscription revenues are so predictable. But $93.8 billion is still a mountainous figure that management has to carefully navigate while executing this pivot. But here's where their strategy gets kind of wild. Despite carrying that massive debt load, Charter has just relentlessly returned capital to its shareholders. Since September 2016, they have repurchased a whopping $80.6 billion in total value of their common shares and units. That includes 188 million shares repurchased, representing nearly 60% of their fully diluted shares outstanding. Talk about an incredibly aggressive share buyback strategy. It really shows that management believes strongly in their long-term cash flow. They're using excess capital to just constantly buy up their own stock and consolidate ownership for whoever is left holding the shares. And that, my friends, brings us to the ultimate question at the heart of this explainer. As Spectrum shifts its immense weight away from legacy video and traditional internet and pushes so aggressively toward mobile and next-gen network upgrades, will these multi-billion-dollar capital investments be enough to reverse the tide of their traditional revenue declines? I mean, they have the scale, they have the cash flow, and they clearly have a plan. But executing a pivot of this magnitude, all while carrying nearly $94 billion in debt, that is absolutely one of the most compelling business stories to watch right now. So what do you think? Will the mobile bet pay off when that CapEx spending finally drops? Thanks so much for joining me to systematically break all this down today. Keep learning, stay focused, and I will see you in the next explainer.